Welcome back to the channel and a new series I'm going to call Quant Wisdom Wednesday. We are going to create series on this channel to represent every day of the week to motivate me to get up and make more content for you guys. So if you like this kind of stuff, make sure you like and share and all that kind of stuff and go to statsedgetrading.com, check out StatsEdge Pro, where you can have access to everything I do from a systematic point of view, putting out the output of all of the algorithms that I'm working on now and the ones I'm running currently and all that kind of stuff. So now let's get into it. The idea behind this one, I want to give just a little bit of information or knowledge on what I questions I come up with and questions I see and things that I'm asked in the Stats of Trading Discord or on Twitter or when I'm reading articles, whatever it is, that I think would help people out. So, one question that I get a lot, and I had a kind of spirited conversation many moons ago. Gentlemen might be watching this on position sizing and how many positions to split up your portfolio into. And the idea is that if you get too much, if you go too much, then all of a sudden you're essentially going to be mirroring whatever the market is outputting and you're going to be diminishing your edge. Too little, that could cause too much risk. So, like a lot of things, this is going to end up being a very personal question to answer because some people are going to be very, very risk heavy and they're going to be okay with a very concentrated portfolio. And some people aren't so much. So let's pop into the screen here and let's actually use an example of some of the strategies that I'm running currently in StatsEdge Pro. Now, we're going to ignore this kind of absolute number right here because this is a bit ridiculous after compounding a portfolio for years and years and years, but we're going to go through some of the statistics. So this is the combined trading part of StatsEdge Pro, where we have revision to the or sorry we have a revision to the mean strategy that I'm looking to add. We have a trend trading strategy and we have a pullback strategy. That covers about the three kinds of trading. There's still some tweaking before the revision of the mean strategy comes out, but the idea is that we can look at our total statistics. This is 30 years of data. We can see what happens. So each of these that I'm going to show you is going to be the same three strategies with the same three trades, but we're weighting them a little bit different. And we are uh, being either very dense. In this case, we are taking a max 5 positions per strategy, so a total of 15 positions across the strategies, and that's it. That's going to be the max our portfolio is ever in 15 positions using a little bit of margin. Now you can see a couple of the stats. We have a 29 or 30% on average year over year gain with a 30% roughly max drawdown. And this number right here, which is MAR, which is the basically it's this number divided by this number, shows 100 or 1.02. And this basically just tells us that anything over 1 is good. Anything over, I think, zero point 0.7, I think, is generally considered good. Anything over 1 is great, but it's how quickly do we recover our money after a drawdown? That's all well and good, but let's actually just go into the graphs themselves, right? You can see this is the strategy. You can see, like anything, has some losing years, 2020, 2018, 2015, some losing years, some losing months, all of that. But I want to focus on just visualizing this graph. Again, up and to the right, that's what we want to see. It's what happens when we combine different strategies based off of making sure they're uncorrelated and all of that, which I'm sure we'll cover in future episodes. But you can see very good upward equity growth, which is what we want, but some pretty harsh drawdowns and some pretty harsh pullbacks in this way up. Right? You can see that when we lose money, we have a couple not huge down years. And keeping in mind, buy and hold, there's a 50% drawdown that happens throughout here and a couple 20-30% drawdowns, but a very volatile portfolio to make that 30% compounded year over year growth, which again is insane and a little bit unrealistic in the long run. Now let's take these same strategies and instead of applying 5 positions per strategy, let's do 10, or 10 positions per strategy. Now, what we're going to see is, I think, what a lot of you are going to expect, that our gain year over year is a little bit worse, right? Let's go in here. So we're only making about 25% year over year growth using these same three strategies. However, our max drawdown has gone from 30% to 20%. The question that you should immediately be asking yourself is, are you okay capping that potential upside in return for having a lower drawdown? And that's going to be the whole position size calculator when it comes in, where what we're talking about is that if you are okay with sacrificing a little bit of gains, but you're okay with also cutting that drawdown, then you're going to want to expand the portfolio to a point, which we'll get to in a second. 20% max drawdown, I think, is easier for people to deal with. And by deal with, I mean stick with the strategy, than it would be to have a 30% drawdown. So let's put these numbers into a real case. Let's say you have a $100,000 portfolio. Let's say you have $1 million portfolio. Let's make the numbers big. So you have $1 million portfolio. A 30% max drawdown means at some point that portfolio has been dropped down to $700,000 and you've lost $300,000 from whatever the high of that equity curve is. That's the max that's occurred. It doesn't mean that that's going to be the max going forward. So we have to kind of accept a potential higher rate. Now, that was, I think, in most cases during 2008 when that occurred, but you have to be okay with that. You have to be okay with this higher max drawdown to say, would I be okay sitting down, $300,000 in this hypothetical $1 million account and be 100% okay with coming in the next week and hitting all the buttons and the next week and hitting all the buttons? Or would I just completely abandon the strategy and move on? If so, then maybe 5 positions per strategy that you're running is too much. Maybe 10 positions where now we're only down to $800,000 from a theoretical $1 million account, only down $200,000. Maybe that's a little bit more manageable. And in return, you're going to be capping some upside. There's no way to do this any other way. If you're reducing risk, you're also reducing return. Now, this MAR becomes way better with a 1.3. So we are getting our money back from the max drawdown incredibly quickly. And if we go down to the graph, you can see a lot of these negative years are now positive years. Although, right, we only have one negative year in 2018 to speak of, well, except for 1993 and 1990. Um, but again, way less variability when it comes to you looking at your year end statements. You're making less money, but are you going to be more okay with this? So these kind of numerical questions should kind of help you decide, are you actually a high risk trader who wants to take less positions, or are you a low risk trader who wants to take more positions? And now if we go down into this graph, uh, and we'll switch back and forth here. Just keep this kind of graph in mind, and then we can go back to this graph. You can see the drawdowns. We'll focus on maybe bring up the Epic pen, but we'll maybe focus on a couple of the drawdowns in particular, where you can definitely see. Like, let's focus on this guy right here, and we'll focus right in this area, and then go over to this chart, and you can see that drawdown is way less pronounced than it is before. And then also, if we take a look at 2020, so this is 2020 for the smooth return, this little blip right here, delete that, do that better. That's a 2020 return right here. Then if we go down to the other one, you can see it's a harsher and faster drawdown that recovers quicker. Last, let's look at this drawdown right here, which is now 2022, 2023, and then go to the smoother return where you can see you're not really down much, you're just not really making much. So if you are that kind of person that you like this return one where things are smoother, then you will expand your portfolio out, which means that if you're not comfortable managing around 30 positions across different strategies, obviously, this is going to be different depending on what it is you're running. These are the Stats Edge Pro ones that we're running right now. But the smoothing this out over time will again help lower those returns. Now, what if we go kind of to the extreme? Right now, we have gone to 20 maximum positions per security. So now we are talking, instead of doubling it from 5 to 10, now we're doubling it from 10 to 20. So across the 3 positions, we are opening up our portfolio to a potential 60 positions per portfolio. Now, you can see you still beat the overall market with 8.3% return for this tested period of the market and a 56% max drawdown. But now you're talking a 19% return, which lowers the return a little bit, but you really haven't lowered that max drawdown. This is the importance of stress testing whatever it is that you do. So now you're taking less return, but you're not lowering the risk. And then that MAR also decreases as well. Now we're below the other strategy, which again just means it takes us longer to get our money back after a large drawdown. And if we go to this return again, you can see, although much smoother overall, there's times here where back in here, the blue line being the S&P 500, where we're barely beating the S&P 500. Yes, we do better on drawdowns than the S&P 500, but we're barely beating the S&P 500. So this is the most smooth equity curve yet. So if you're somebody who is very risk averse, you might be okay with the smoothness of this equity curve in exchange for lowering the drawdown. However, if you're managing 60 positions, at some point, I think you would do just as well by building a system that you're holding the S&P 500 when you're in a bull market, and maybe if it dips below the 200-day moving average or something, you get out. You could probably get not quite these returns, but you could probably get close to them. You can see in this one, as I scroll up, there is only one negative year, right? So reducing the ability to sit through negative years, but we're very much capping the upside. So at the beginning, I said ignore the absolute numbers, but we're going to take a look at them here. Again, understanding that if I think the most return gets to like $500 million, there'd be liquidity issues. There's no way you could funnel that kind of money through them, but we'll use them for a little bit of reference. So from here to here, where we haven't really changed our max risk, this $100,000 compounded over these 30 some odd years turns to 42 mil. This one turns to, I think, triple that. Yeah, 180, with again only 1% more in your max drawdown risk. And this one goes all the way to, again, all these are ludicrous numbers, six something, right? $500 million. It's absurd. But the point I'm trying to get across is that there is a point where some people, if you were young and this is money that you don't necessarily need and you're okay with potentially losing a third of it at any given time due to any kind of market event, yes, maybe limiting your positions to five per strategy could be something that totally makes sense. If you're somebody who is, you look at that and you absolutely just get a visceral reaction, then expand your positions out. If you're ever nervous about a position, it makes sense to expand that position out into other positions to lower that distribution out. But there is a point of diminishing returns, and this is kind of the spirit discussion I had with, again, Brett, if you're seeing this, a while ago, where eventually you get to this upward limit, right? If I reran this again, let's actually just do that for fun. If I reran this again and I reran this with, let's say, something ridiculous, let's say 50 positions per one. I'm just at this screen, so then again, my code is just a little bit obscured. But if we rerun this again, I am willing to bet, and I could be wrong, that we again have this diminishing return in which our return continues to lower, but we're not getting that benefit of risk. So the question that we have to continue to ask ourselves is uh, when are we doing too much when it comes to a risk return kind of scenario? So I'm going to put this on pause. I'm going to run this and we will be back in just a second. So here we are back with what would happen if we had 50 for per position. So now we're talking 150 potential total holdings at one time, which a lot of people would say, well, you just couldn't physically manage that. Well, of course you could, right? You can systematize things and upload your trades to different brokers and all of that. So this isn't unrealistic from that respect. But what you can see has happened is we've cut our return again, and not really cut our max drawdown. So you're starting to see this diminishing return where spreading ourselves out over and over and over again is only hurting the return side of things and is not benefiting us from the max drawdown side of things. We're back to more years of total drawdown, and the equity curve, it doesn't seem as smooth anymore. We're spending from 1990 all the way till 2000 underperforming the overall market before things start to pick up. So this did a really good job. I did this on the fly, so I was a little nervous about it, but a really good job of showing what I was talking about here. So if we end up searching for, um, let's just go back and reiterate, right? 30% gain and a 30% max drawdown on 15 position total. Now we go from 10 to 10 and we go from 24% return to a 21% max drawdown. To me, that's something that would make sense. And then we go down to 20 positions per, and we have a 19% return and a 20% max drawdown. So again, we haven't really changed that max drawdown. We've gone from a 21 to a 20. And then 50 positions per, a 15% gain, and only a still, you could round it to 18% or 20% max drawdown. So this is what you need to look at, and what a lot of people don't when they look at their trading. They spend a lot of time focusing on what do I buy and when do I sell it and when. But what I want to do a lot in this series is talking about a little bit more of these nerdier things, where we're talking about not what to trade and when to buy and when to sell, but how much, right? In how much am I splitting myself too thin, in which it just doesn't make sense for me to trade the at all. Like at what point, with a 15% year over year gain and a 20% max drawdown, again, I think you could just get an ETF system that says, hey, if the market closes below a 200-day moving average, get out, and then back above 200-day moving average, get in, and you'll sit out a lot of these returns, and you'll probably get somewhere near this, give or take, anyway. And then there's the tax return credits and all this kind of stuff that you'd gain. So when you're sitting down and thinking about, hey, I'm looking to implement these trading systems, spend some time thinking about when am I trading too much and when am I trading too little. And like most things, there's going to be a balance there, and that balance I think is going to help with your return. So again, let me know what you think of series like this. I'm going to try for a few weeks. The goal is a video a day on most days. Life happens, but a video a day tailored to something different. Let me know what you think. Give me feedback. Go on over to statsedgetrading.com if you want more information like this, and I'll talk to you guys soon.